Hey there, and welcome. Ever look at a company and wonder what it's really worth? I mean, beyond the stock price, what does it actually own? Well, today, we're going to pull back the curtain and take a look at the absolute building blocks of a company's value.
So let's start with a big question. If you wanted to see everything a company owns and everything it owes all at once on one single day, how would you even do that? How could you take a financial picture? It sounds pretty complex, right? But believe it or not, there's a tool designed for exactly this.
And that tool is called the balance sheet. Honestly, the best way to think about it is exactly like a snapshot picture. This isn't a movie showing you how things went over the last year. Nope, it's a single photo taken on one specific day that freezes a moment in time, perfectly showing what a company owns, its assets, and what it owes. Okay, so for the rest of this explainer, we're going to zoom in on just one half of that snapshot, the really interesting part that lists everything a company owns. Let's get right to the heart of it. What exactly is an asset? You know, the definition is actually pretty straightforward. An asset is anything that has value, or, and this is the important part, the power to earn money for a business. It could be cold, hard cash in the bank, the giant machines on a factory floor, or even something you can't touch, like the power of a famous brand name. These are the resources that literally fuel a company. Now, not all assets are created equal. And to really understand that financial snapshot, we've got to break them down into three main categories. This helps us see both the short-term and the long-term resources a company has to work with. And here they are. You've got your current assets, your fixed assets, and then maybe the most fascinating of all, your intangible assets. Let's dig into each one, starting with the easiest to get your head around. First up, current assets. The key word here is current. These are things that are either already cash or can be turned into cash super easily. We're usually talking within a year. So this includes the cash itself, of course, investments like securities, all the raw materials and finished goods waiting to be sold, and, yep, even the money that customers still owe the company. Next up, we've got fixed assets. Now, unlike current assets, these are the heavy hitters, the long-term, physical stuff a company needs to do its business. Think of the big machinery in a factory, the fleet of delivery trucks, the office buildings, and the land they're all sitting on. You can literally walk up and touch these things, which is why they're also called tangible assets. And finally, we get to the really cool ones, the assets you can't touch, intangible assets. They might be non-physical, but wow, they can be unbelievably valuable. Goodwill, for instance, that's the value of a company's amazing reputation and its loyal customers. And just think about powerful brands. Their ability to earn money is enormous, making them a massive, massive asset. Oh, and here's a quick and useful little tip about the language. Depending on where you are in the world, you'll hear different words for the same thing. So in the UK, people talk about stocks and debtors. But in the US, you're way more likely to hear inventories and accounts receivable. It's the exact same concept, just a different way of saying it. All right, so we've got our snapshot of all these assets. But there's a problem. A big one. That snapshot is frozen in time. And in the real world, the value of things changes, right? A brand new machine doesn't stay brand new for very long. This brings up a really critical question. What does happen when that brand new truck starts getting worn out? Or when that top-of-the-line computer is basically a fossil in just a few years? You can't just keep listing them on the books at the price you paid for them, so how do businesses deal with this reality? The answer is a super important concept called depreciation. This is the official accounting way of showing an asset's loss of value over its useful life. It's how a company admits, hey, this thing is getting old. By the way, in the US, you'll often hear the term amortization, which is used in a similar way, especially for those intangible assets we talked about. Let's just track an asset's life to see exactly how this works. Imagine a company buys a new computer. In year one, its value is officially written down in the accounts. Year two, it gets written down again. And by the end of year three, its value might be completely written off. That means it has zero value on the company's books, even if it's still plugged in and working. So this whole process of writing down value, it leads us to probably the single most important idea in this entire explainer. The value written down in the company's accounting books might have very little to do with what that asset is actually worth in the real world. And this is the critical difference between book value and market value. The book value, that's the official number in the accounts, after all that depreciation. But the market value, that's the real world number, what someone would actually pay you for it, right now, today. And as you can probably guess, those two numbers can be very, very different. For example, a company might own a piece of land it bought 50 years ago. On the books, its value might be tiny, but if the neighborhood around it has boomed, its market value, what it could sell for, could be millions and millions of dollars more. And of course, the opposite can be true too. A company might have some really specialized piece of machinery. If they didn't depreciate it realistically over the years, its book value could look pretty high. But in reality, good luck finding someone who'd actually pay that much for it. Its market value is way lower. And this all brings us to the final and most crucial insight. That snapshot, the balance sheet, it's incredibly powerful, but it is incomplete. There are things of immense value that never, ever show up on it. As the source material so perfectly puts it, think about the knowledge and skills of a company's employees. A brilliant team could be a company's greatest asset, but on the balance sheet, it has a book value of 0. And that leaves us with a final, big thought to chew on. The balance sheet gives us a fantastic snapshot of a company's assets, but we now know it can't possibly show us everything. Which raises the ultimate question. When we look at any company, just how much of its true, actual value remains completely invisible?